DiDi Global Inc. is currently trading as an ADR, an American Depository Receipt, on the New York Stock Exchange. It's trading under the ticker symbol DIDI with a current share price of $11.14 per share. The company, as well as the stocks, had a brutal past month, both facing criticism from the U.S. government and more regulation and crackdown from the Chinese government. On top of that, it's faced criticism from U.S. investors, foreign media, and domestic media. This has all resulted in its stock price trading down over 21% over the past month, down to a market cap of 54.45 billion US dollars. This is down from DiDi's 52-week high of $18.01 per share and just barely above its 52-week low of $11 per share. On top of that, DiDi's also facing a class action lawsuit. And again, if we want to just reference some articles here to show what the criticism is like, here's one from Forbes titled "DiDi Means War, a Financial Cold War with China." Another from the Wall Street Journal, "In the New China, DiDi's data becomes a problem." Another one here, "What China expects from businesses, total surrender." And the last one here that I'm going to reference, "China's cyber watchdog sends authorities to DiDi as it amps up probe." Now, all of these articles, and not just these articles, but everything moving on, including China, including the United States, including U.S. investors, foreign investors, and just so many moving parts here, put downward pressure on DiDi stock and are really causing investors to be skeptical and worried, justifiably, about the future of this company and Chinese companies as a whole. So why is DiDi stock down? Well, let's go more in depth and investigate this matter. This is the DiDi Stock Analysis. I'm your host, David Scheuer, and this is Stalker Finance. Twitter.com/StalkerFinance for more information. The newsletter link will be below. Now, first off, if you really want to understand the situation, you need to know the history of China and its relationship to capitalism, as well as its relationship with the United States. However, this is not a history video. I'm not going to dive into this subject in a very in-depth manner. I'm going to make another video that specifically focuses on just the history of China, capitalism, and its relationship with the United States, also involving Hong Kong. I'm going to touch on Shenzhen as well. But let's move on from this and really talk about just the relationship between DiDi and especially the United States and China. So you have these three moving parts here, at least three major moving parts. And what's going on here is you have this interchangeable relationship. You have a battle between the United States and China, and I don't really want to say a full-on battle because they're not in war, there's nothing like that. It's almost this kind of proxy Cold War-ish thing going on between its financial centers, between companies, and between its governmental bodies. Knowing that neither of them could go to complete all-out war, because if that were to happen, you have complete, global devastation. But what's going on with that is you have this kind of weird, I almost kind of think of it as kind of a weird arm battle where you are both gripped together, but neither of you can really push too much either way because otherwise that'd lead to way too much conflict. And so you're kind of just bouncing off of each other. And this is really strange conflict going on. With the United States needing China and its especially the United States companies needing China for its manufacturing abilities, and China needing the US because, well, the United States is its primary customer. So you have this really weird battle going on, and I don't even know if battle is the right term to use, but this really weird conflict going on. And then you have the investors who are investing in DiDi, and then you also have China cracking down on DiDi, as well as the United States. You have first off, you have the United States and investors. The United States is cracking down on DiDi, kind of beating up on it in simple terms. And United States investors are saying, okay, well, if our government's beating down on DiDi, we're going to have to do the same thing because we're becoming very skeptical of this company. And that's resulting in a lot of downward pressure on DiDi's stock. On top of that, you have the Chinese company where, DiDi is headquartered. It is headquartered and located and founded in China. Well, the Chinese government is also beating down not just on DiDi, but giant tech companies as a whole and really establishing itself, saying, look, you might be this powerful, massive tech company. And then in the United States, you might have a lot of influence as this company. But here in our country and with our government, you are not the most powerful. The Chinese government will always be the most powerful. And that's really the statement they're making right now. So you have the United States and China. You got the United States beating up on DiDi along with U.S. investors being skeptical, criticizing DiDi, etc., etc. Then you also have Chinese government beating up on DiDi. Then what you have, this creates an all-out bombardment on DiDi. You have all these moving parts, and that just forces the stock downward in simpler terms. On top of that, it leads to just an all-out explosion, a complete hellscape for DiDi right now. Even if the company's fundamentals might be solid, we're going to dive into the fundamentals in a little bit here. DiDi is really facing criticism from all fronts here. It's fighting in its own country. It's fighting the foreign country, foreign media. On top of that, it's fighting domestic media. It's also dealing with just so many moving parts here for DiDi that as an investor in this company, It just seems like a very risky investment and an investment that you'd really want to watch from the sidelines right now and not be directly involved in. And so this is kind of, in a sense, creating this, David versus Goliath system here, where you have Diddy as David and then the government's especially the Chinese government, as Goliath. But that's really not the case. In fact, that's actually a very bad analogy. In fact, it's more like you have a Goliath, which is Diddy, with a massive market cap. It's a $50 billion company. And then you have essentially a godlike entity, which is the Chinese government, where Diddy really doesn't have much power against the Chinese government at all. We already saw with past CEOs, such as the CEO of Alibaba, Jack Ma, who made a comment criticizing the Chinese government, and he disappeared for a few months. So, and although he turned out okay, that made a massive statement to the Chinese public. On top of that, the Chinese government completely controls the media, and it could tear apart Diddy's entire company if it wanted to. So in reality, it's a Goliath versus some godlike entity, if we're going to use a metaphor or an analogy to better explain the situation. Now let's go ahead and reference some articles to get a better grasp of what's going on here and do a little market research, essentially. So, Chinese regulator pulled its apps from the app stores on the grounds of protecting national data, security, and public interests. At the heart of the Diddy fiasco, and to a large extent China's increasingly aggressive antitrust campaign, is the question of what Beijing expects from private enterprises. The answer is a lot more complicated than in the United States and Europe. And because of this complication in China, that complications are also translating over to the United States and creating complications over here, with the United States questioning, should we even trust Chinese companies and even allow them to operate in the United States at all? We're allowing these companies to go public in our nation and compete with US companies. Should we even allow that? And there's been a lot of debate on that topic about whether they should just completely ban numerous Chinese companies operating in the United States. So, on top of that, to reference another article here, on Friday, China sent out state security and police officials and other regulators into the company's offices. And as the government zeroes in on the cybersecurity practice and collection of personal information, the visit was a part of a review, and I'm putting that in quotes, ordered just days after shares sold Diddy's $4.4 billion initial public offering and how it started trading publicly in New York. So there's a lot going on here. And just the last one I'm going to reference is it's important to keep in mind that the Chinese tech companies operate in a country ruled by an increasing autocratic government that demands the private sector surrender with absolute loyalty. And I think this one really exemplifies the situation and gives an example of what's going on the best. So unlike the antitrust campaigns that the European and American officials are pursuing in their regions, China is using the guise of antitrust to cement the Communist Party's monopoly of power, with private enterprises likely to lose what's left of their independence and become a mere appendage of the state. And, I don't know how drastic this is going to become, because at the end of the day, China needs these companies. It needs large tech companies operating in its state to generate revenue, and so that the Chinese government and the Chinese country can continue to grow and become more of a world superpower in the coming years. So it really needs them. It can't just completely tear apart these companies, but it can have complete control over these companies. And control is really what the situation in China is about, is the government needs control over these companies. They can become big, they can have lots of wealth, but they cannot have the same power over the Chinese people that the Chinese government will always have, especially, at least in the near and far future. So Diddy is currently trading with a market cap of $53.35 billion. And let's do some comparative analysis here. And we're going to compare this company to Uber, its competitor in the United States, its primary competitor at least. Now, Uber actually has a market cap of $85.28 billion. And that's quite interesting when you go ahead and look into the fundamentals here. So when you're looking at the fundamentals, and we're going to use the Form F1 registration statement for Diddy right now. If you dive in here, Diddy currently has 493 million annual active users, 15 million annual active drivers, and there's 41 million average daily transactions for Diddy. Keep in mind that, China's population is more than Europe and North America's combined. That is a massive customer base for a company that essentially has a monopoly on the rideshare market there. Now, if you look at the monthly active platform customers or consumers for Uber, it totals at only 98 million. And that's actually for the entire quarter of Q1 2021. If we compare that to, the daily transactions or annual active users for Diddy, it's just immense. So let's move on here and let's go ahead and look at the total trips at 1.44 billion in Q1 2021 for Uber. Significant amount to say the least, but it also has not recovered to where it was pre-coronavirus. And it's not recovering at the rate investors would like to see. And Uber stock has definitely reflected that over the past few months, or at least the past few weeks. And the point I'm trying to make here is DiDi is a massive, powerful company, and its financials, in some instances, are better than Uber's. Yet its stock trades at a massive discount to Uber. And part of that has to do with the fact that there's just a lot of downward pressure on the stock, especially with it being an ADR operating in the within China, facing the Chinese government. And so a lot of it doesn't necessarily have to do with the fundamentals of the company, but it more has to do with outside, I guess we could say, outside conflicts of DiDi that happen outside of the company and that are forcing upon this company and really just kind of squeezing it and bullying it and beating this company up. And so if we go ahead and look at the financial data for DiDi here, you'll see that its revenue totals at 6.4 billion US dollars. And if you look at Uber's revenue here, well, it totals at $2.9 billion. And this is for just the last quarters I could find for these companies. So DiDi's already doing significantly more revenue than Uber. Let's go ahead and look at some more financial data here. And we're going to look at operating income. And operating income, if we go ahead and look at it for DiDi, is also greater than that of Uber. Uber's operating income is negative 1.5 billion US dollars. And if we go ahead and look at its net income, well, Uber has a net income of negative 108 million. It's only been profitable for one quarter in 2018 Q1 due to other reasons. However, it has no clear path to sustainable profitability in the near future, at least in my opinion. Definitely challenge that in the comments below if you don't believe it. If we look at DiDi's net income, however, you'll see that they had a profitable quarter with 837 million, and that is after income tax benefits. So 837 million and as of 3 months ended March 31st, 2021, as of that quarter, and that's the 837 million US dollars. By the way, if you're looking at the financial data, if you're following along here, there's also the currency in RMB. Don't make sure to not get those mixed up. It'll totally mess up your financial models and everything. Let's move on here, though. So my point is, DiDi's doing more net income than Uber. It's a profitable company. It has a much larger customer base, and that's just in the company it's operating in, and it's continuing to expand. On top of that, DiDi is doing better when it comes to operating income as well, and DiDi is earning significantly more revenue than that of Uber, and it also has a more diversified revenue streams than that of Uber, operating as a sort of Amazon. And many people have argued that Amazon and DiDi is DiDi's actual competitor, not Uber. And if we move on here, we can also look at operating expenses here. Uber has $2.71 billion in operating expenses. And, well, DiDi, no surprise here, it has way more operating expenses than Uber with $7.4 billion in operating expenses there. And that's total cost and losses. So if we go ahead and look at the margins here, Uber has a profit margin of 3.7%. DiDi's is obviously better than that. We already know that. On a positive note for Uber, though, Uber's profit margin has continued to trend upward for the past few quarters, which I guess, as an Uber investor, would give you some hope for this company to one day reach sustainable profitability. On top of that, if we look at the consolidated statement or consolidated balance sheet data here, as well as consolidated cash flow data for DiDi, and we compare that to Uber, well, Uber has operating cash flow of 611 million, where that's negative 611 million, by the way. If we look at DiDi's, though, it is at negative 937 million. So DiDi is losing significantly more money in terms of operating cash flow compared to Uber, and a lot of that has to do with numerous things, especially operating activities. If we look at operating cash flow again, that's 611 million. And if we compare that to DiDi, that is 937 million. And I'm kind of repeating myself here. Let's move on, though, and look at cash and cash equivalents. Uber currently has $4.8 billion in cash, and DiDi has $3.6 billion in cash. But again, this will drastically change since this document I'm looking at is pre-IPO for DiDi, not after the IPO, and it would have raised, millions, if not billions of US dollars. So now let's also look at shareholder equity here. Uber has a positive shareholder equity, making its assets worth more than its total liabilities. If we compare that to DiDi, that is not the case. DiDi's shareholder equity was actually trading at a shareholder's deficit. So let's do over the summary of DiDi here. There's political and social risk, but the company will continue to grow and become more profitable. I am confident in Diddy's business model. I actually think it having a more diverse revenue stream, it having numerous outlets to create new revenue streams on top of its revenue streams already. It's a profitable company. It has a shareholder deficit, which is a big negative. But again, I believe Diddy will actually continue to perform well. But the major problem that just completely overlooks all of this, or completely stomps on all of this, is the political and social risk. Diddy cannot maintain the direction it's heading with this type of risk. Its stock is going to get completely suffocated. And what's going to happen there? It's going to create a lot of pressure on the company's executives to perform well, which will lead to, in my opinion, more drastic measures being taken at the company, which could lead to a big downfall for it. It has competition in the US, and although that competition on a fundamental level isn't necessarily much better than Diddy, in terms of the fundamentals of the company, especially, in relation to the financials, well, it has the backing of the US economy and the US government, where Diddy has pretty much only faced regulation, scrutiny, and criticism from media, from institutional investors, and also from retail investors, whereas Uber has not faced nearly the same as Diddy has right now. Uber has definitely faced a lot of criticism, regulation, etc., but is not on the same level of Diddy. And on top of all that, way worse than all of that, Diddy is facing the complete godlike entity, even if Diddy is a Goliath, which is the Chinese government that could, with just a signature or not even just in one order, could go in and shut down Diddy's entire company or take over the entire company. That's all it would take for this to happen. And that is a very risky investment as an investor. So that is why Diddy's stock is trading downward. And that is why Diddy is down 20% this month. Will it ever recover? I have no idea. In fact, I don't see it recovering in the near future. That's for sure, unless it has some incredible results in the coming quarters. And unless, the United States and China kind of decide to let Diddy operate, and they decide not to regulate the company, which that seems like a story too good to be true for this company. So anyways, this was kind of a drawn out video, but I hope this explanation helped. I hope the comparative analysis to Uber kind of helped, just to give you a grasp on the company itself and the financial position and operating position of this company compared to a US one. And I hope you got a little bit of background on the whole, kind of craziness going on between the United States, China, investors, and Diddy right now, which is a complete hellscape for this company. Anyways, thanks for watching this video. Please subscribe, twitter.com/StockYourFinance for more information. Check out these videos as well, and the newsletter link will be below. I'm also considering putting these videos in podcast form, where I'm going to do a Monday through Friday videos. Still thinking about it, but if you want that to happen, comment it below or tweet at me. Give me some encouragement there. Anyways, thanks for watching. My name is David, and I'll see you guys in the next video. Peace out.